Part of the reason you've seen softness in gold is there's been a systemic margin call, if you will. What's been sold, gold is one thing that's been sold to raise cash to meet margin calls. Yes, it's a hedge, but also it's a piggy bank. You're going to see institutional money come in, and at some point, there's going to be real fear out there. Silver's going to outperform gold simply because of the ratio. It's still over 60 to 1, and it comes out of the ground at 10 to 1. You have to pay attention to the industrial side. I mean, that's the story industry, the solar industry, medicinal uses, technological uses, and we have a war going. We have two wars going on. War uses commodities, disrupts supply chains for commodities. So I think commodity prices are going to go higher, and I think inflation is going to go higher, and I think you're going to see interest rates all over the world go much higher. If credit gets hampered, and I fully expect credit to have a huge problem, you're going to see real estate across the board collapse. Back in 1980, you had the Dow at 800 and you had gold at 800. I mean, you very well could see the Dow collapse to 25,000 and gold go up to 25,000. There you go. Pretty close to a bottom. I think we probably have already made bottom a week ago, Sunday morning. I'm sorry, Sunday night, Monday morning. You got gold down to right at 4,000 and you had silver at what, 60, $61. I think they ended the day up on that on Monday. But it looks like the bottoming process. It's happening. Whether we hit absolute bottom or not, I don't know. But once this thing bottoms, I think you're seeing because of the physical demand, I think you're going to see much higher prices, and I think new highs by the end of the year anyway.
Right. So, Bill, we have few camps now in this precious metals market. Some people are afraid that maybe we have already peaked, similar to what I've seen in 2011. What would be some of the differences between the two environments that you're seeing right now?
The biggest difference is the physical demand. I mean, you can see that on the exchanges with the inventories getting hammered. You can see that where refiners can't keep up, and you can see it with central banks have been buying. Although I will say part of the reason you've seen softness in gold is there's been a systemic margin call, if you will, and what's been sold. Gold is one thing that's been sold to raise cash to meet margin calls. So yes, it's a hedge, but also it's a piggy bank.
This bottoming process might not be weakness, it may be forced liquidation hiding real demand. As Bill Holter points out here, the key difference versus 2011 isn't price action, it's physical supply getting drained, while paper markets still dictate short-term moves. When refiners can't keep up and central banks are accumulating, yet prices dip, that's usually a liquidity event, not a trend reversal. Margin calls in stressed markets often force investors to sell their strongest assets first, which distorts true demand signals. That disconnect matters for portfolio timing and positioning. Next, Bill Holter talks about who actually drives the next major move.
If we look at, this whole global chaos that we're seeing right now, what do you believe would be the main driver, Bill? Would it be, these big players, funds getting involved in this sector, or do you believe it would be average normal people who would want to seek protection using precious metals?
Yeah, I don't think average normal people. Uh, that's not where the firepower is going to come from. You're going to see institutional money come in, and at some point, there's going to be real fear out there, and fear is a much greater emotion than greed. And
Certainly.
also remember, on these paper exchanges, the leverage is to the downside. So if there's margin calls uh, via fear, it's gonna it'll be shorts being forced to cover, in my opinion.
And would you see, Bill, silver following gold very closely, or do you believe there could be a little gap between the two?
I don't think it matters. I think longer term, silver's going to outperform gold simply because of the ratio. It's still over 60 to 1, and it comes out of the ground at 10 to 1. I mean, even if we don't get back to the historical number of 16 to 1, even if we get back to 30 to 1, it's still silver's going to basically double the performance of gold from here.
And do you pay attention towards that industrial side of silver, Bill, or is it purely silver following gold?
The real move won't start with retail. It'll start when institutions are forced, not willing, to act. As Bill Holter points out here, fear-driven flows, not steady buying, are what trigger explosive upside, especially when leveraged shorts get squeezed in thin liquidity conditions. The gold-silver ratio sitting above 60 to 1 versus a 10 to 1 mining reality highlights a structural imbalance markets keep ignoring. Historically, when ratios compress even halfway, silver dramatically outpaces gold, reshaping portfolio returns fast. That's not speculation. It's positioning math colliding with panic. Next, Bill Holter discusses whether industrial demand quietly reinforces that imbalance.
No, you have to pay attention to the industrial side. I mean, that's the story. Industry, the solar industry, medicinal uses, technological uses. There's so many more uses today than there was 10 years ago. And that's a big part of the offtake from the inventories has been for end uses.
Right. Uh, so one of the sectors that people on this channel follow would be mining stocks. How are you seeing mining stocks in the current environment? Because from the fundamental perspective, some would view that they are, with these margins, still relatively undervalued, even at the current commodity price. So if the commodity price goes higher, that should give them even more fuel.
Right. Yeah, I am in that camp. I believe that the miners are, as a group, undervalued. I think part of that is because they're still not trusted. Investors saw what they did in 2009, 10, 11. They spent like drunken sailors and they brought their cost of production way up with all their spending. This time around, they've kept spending locked down pretty well to this point. And if they continue to do that, they should be really good performers because, like I said, I think if you look historically, they're way undervalued compared to where they were historically.
Everyone talks about gold prices, but the real story might be buried in how silver is actually used. As Bill Holter points out here, industrial demand, from solar to tech, has quietly tightened supply far beyond what most investors price in, creating a structural floor under silver. Meanwhile, mining stocks remain discounted not because of fundamentals, but because of trust issues dating back to post-2008 capital mismanagement. If discipline holds this cycle, margins could expand sharply with rising commodity prices, offering asymmetric upside. That gap between perception and reality is where opportunity forms. Next, Bill Holter unravels where smart money flows within mining stages.
Yes, certainly. So if we look at this whole mining curve, Bell, would there be a certain stage of that curve that you would be more interested in? Would be mainly the producers or maybe developers or juniors?
In the later stages, the hot money is going to be looking for the next big find. So in the later stages, you want explorers, you want the exciting stories. But as it stands right now, uh, there's not been a lot of froth in exploration companies. The market wants some kind of production, some type of cash flow, so that they don't have to come to market and dilute. Because that was the story. You had what 2,500 or 3,000 miners go bankrupt over the last 10 or 15 years because they had no cash flow and they needed capital, and there was no capital to be had, or very little capital to be had in the mining industry.
Yeah, definitely. If we look, Bill, at the history, so commodities and precious metals, they usually follow certain cycles. So h- I suppose what I'm trying to ask you, how are you viewing, precious metals? What part of their cycle would it be? So if it's late cycle, how long would you expect that cycle to continue? Or maybe it's different this time.
There's no way to tell. I mean, we're so far out, and we have a war going. We have two wars going on. Um, and obviously, war uses commodities. War disrupts supply chains for commodities. So I think commodity prices are going to go higher, and I think inflation is going to go higher, and I think you're going to see interest rates all over the world go much higher. And that's a problem because the financial system is so leveraged.
Most investors chase excitement too early, but this cycle still looks like it's rewarding discipline over speculation. As Bill Holter points out here, the lack of froth in exploration stocks signals we're not in the euphoric late stage yet, where risk capital floods into unproven stories. After thousands of mining bankruptcies over the past decade, markets now demand cash flow, not promises. A major structural shift in capital allocation. Add in geopolitical tensions and supply chain disruptions, and commodities gain a macro tailwind. But rising rates threaten leverage systems at the same time. That tension defines this cycle's risk. Next, Bill Holter discusses how this ties into broader commodity inflation.
Commodities, Bill. What would be some of your other, favorite commodities other than precious metals?
Oh, I think pretty much across the board. I mean, the if you go back, well, since 1971, go back, 50 plus years, the sovereign governments, central banks have debased their fiat currencies so badly that I view commodities across the board as undervalued. And I mean, this is going to end in either a deflationary collapse or hyperinflation. And central banks, sovereign treasuries, deflation is not acceptable because you've got things going bankrupt left and right. They will debase the currencies to zero, basically, and we're going to live in a world where, a cup of coffee might be $100. It's the gold and silver don't go up, commodities don't go up, nothing goes up or down except for what it's measured in, and that measurement are the fiat currencies, which have been debased so badly.
If things go really bad, Bill, and if dollar hyperinflates or if we go into the deflationary situation, what would you expect to happen with the currency? So will they try to create a new currency and try to convince people that that this new fiat currency is much better, or will they try to back it by gold? Because if you look at the history, politicians, they want to have control, right?
The real risk isn't commodities rising. It's currencies quietly losing their measuring stick. As Bill Holter points out here, since 1971 the system has relied on continuous currency debasement, meaning price increases are often just reflections of weakening fiat, not true asset appreciation. That raises a critical question for investors. Are portfolios growing in real terms or just keeping pace with inflation erosion? Policymakers consistently reject deflation because it exposes debt fragility, which makes currency dilution the default path. That dynamic reshapes how you value everything from equities to commodities. Next, Bill Holter unravels what governments may do next with currencies.
So gold-backed currency wouldn't be likely.
Yeah, it's pretty obvious all over the world. Just for the control, governments are going to want central bank digital currencies. There's still going to be fiat currencies. They're not going to tell you that. They're going to tell you, oh, we have a brand new wonderful currency. Same boss, the same new boss as the old boss. And I don't think those are going to, I think those will fail largely. And at some point in time, and the BRICS are a perfect example of wanting to create a currency that has backing, commodity backing, gold backing, silver, oil, et cetera, et cetera. They want a real currency that will allow for real and fair or true settlement. The way it is right now, there's no settlement because the U.S. imports something. What do? They just print more money. Europe imports something, they print more money. That's what these governments do. But I don't think that I don't think the next central bank digital currencies, I don't think they will survive. I think they'll be questioned. Maybe they only last 6 months or a year. I don't know.
Okay, and you believe that, a way out for normal average people would be to convert that fiat currency into physical, tangible things that cannot be printed, right?
Digital currencies may be sold as innovation, but the real objective could be tighter control over capital flows. As Bill Holter points out here, central bank digital currencies don't change the underlying issue. They simply digitize the same fiat system while increasing oversight and programmability. Meanwhile, the emergence of commodity-backed alternatives from global blocs hints at a growing distrust in unbacked currencies, especially as trade imbalances widen. For investors, this isn't just monetary policy, it's a structural shift in how value is settled globally. That uncertainty creates both risk and opportunity across asset classes. Next, Bill Holter discusses how individuals can position outside this system.
Get out of the system. If you're going to own stocks, you want to get your stock certificates.
Would that include real estate, land, and things like that as well?
That's a tough one because real estate is valued currently at super high levels all over the world. And the reason being, borrowed money, credit has been available to buyers to use to buy properties. If credit gets hampered, and I fully expect credit to have a huge problem, if there's no credit available, you're going to see real estate across the board collapse. It'll collapse in fiat terms and collapse even worse in terms of gold and silver, the real measuring stick.
What's interesting is that even now, the ratio of real estate, gold to real estate, is actually very favorable because I believe real estate is cheaper now measured in gold than it was in the 1970s, which again, it's important for people to understand, how much fiat lost its value because it's almost impossible for a young person to buy real estate. But if he or she would have saved in gold, that would have been a completely different story.
Yeah, the dollar itself is down from 1971. The purchasing power is down, what, 97, 98%.
Real estate feels stable until you realize how much of its value depends on cheap credit staying alive. As Bill Holter points out here, property markets globally are inflated by decades of easy borrowing, and if credit tightens, as seen during past crises like 2008, valuations can reset quickly. The overlooked angle is measuring real estate in gold terms, where affordability tells a completely different story than fiat pricing suggests. For investors, this challenges the assumption that property is always a safe hedge. Liquidity conditions, not just demand, drive prices. Next, Bill Holter shows how this connects to broader purchasing power erosion.
If we look at stock market, Bill, so of course, if you look at valuations, they're really, really high. But it looks like every single time there's weakness in the market, investors are so used to buying the lows that market just continues to go higher. When do you think, I suppose, what would cause that to change, Bill?
A credit crisis, a currency crisis. You have to understand that financial markets, including stocks, are grossly over-levered. And when that leveraging unwinds, you're going to see much lower prices. I mean, even in my lifetime, you've seen a Dow-to-gold ratio at 1-to-1. Back in 1980, you had the Dow at 800 and you had gold at 800. I mean, you very well could see the Dow collapse to 25,000 and gold go up to 25,000. There you go. You're back to the 1-to-1 ratio.
Yeah. Would you expect, Bill, let's say a year or two from now, a stock market to be higher from here or lower?
In fiat terms, very well could be higher. But in terms of gold, if you measure it versus gold, I think the stock market will be much, much lower. In other words, it'll take less gold to buy the same stock market unit.
Markets look resilient, but that strength may be built on leverage that hasn't been tested yet. As Bill Holter points out here, persistent dip buying behavior often signals excess liquidity, not fundamental strength, especially when valuations remain elevated across major indices. The Dow-to-gold ratio returning toward 1-to-1 as seen in 1980 would imply a massive repricing either through falling equities, rising gold, or both. For investors, the key isn't nominal gains, but real returns measured against hard assets. That distinction becomes critical in volatile macro cycles.